Hey everyone, have you ever wondered how to be a trend investor? Well, as an investment actuary with over 10 years experience, I've seen my fair share of investment strategies. So join me as I describe trend investing through 10 key principles. Let's get into it. So first, let's define trend. So trend is essentially a strategy that profits from trending markets. What is a trending market? How do we identify trending markets? We basically make the assumption that markets that have been going up will continue to go up into the future. And similarly, on the downside, we assume that markets that have been going down will continue to go down in the future. This actually conflicts with the efficient market hypothesis because past price history should not impact future prices. And when this strategy was discovered, lots of people thought that it shouldn't exist. Cliff Asness, the founder of AQR, was one of the first hedge fund managers to make this strategy famous, and he did it in a systematic way, although it's possible to do it in a qualitative way. So here are the 10 key principles for trend following. Principle number 1 is that you can trade anything so long as it's trending. So if you look at lots of different price histories, it doesn't really matter what the underlying is. Prices tend to move in trends, and that's largely down to behavioral finance. So not because of any particular financial maths, it's mainly down to the fact that people tend to buy things that have gone up in the past. People tend to put value on the past track record of an investment. So there's all sorts of things you could trade. Trend following is popular in commodities, so you can trade orange juice, pork bellies. People apply this method to all different markets, so long as it's trending. Markets can just chop sideways, and that's not conducive to trend strategies, but most markets will trend from time to time. So principle number 2 is that you aim to profit from every trade you take, but you know your maximum loss, i.e. every trade has a stop loss, and that's the point at which you get out. And this is to prevent extremely large downside risk or you just being completely wrong on the trade. Stop losses are set quite tight, so typically around 2% drawdown, or some traders even have like a 0% stop loss. So if the trade doesn't immediately go in their favor, they just get out straight away. And both of these techniques help to limit downside. The 0% stop loss actually came from one of the books I read, The New Market Wizards, I think. And they spoke about how to protect the downside, you can immediately get on the trend. If it doesn't go in your favor, just get out straight away. And that can help prevent your downside, because what you ultimately want to prevent is risk of ruin. You want to be able to continue to play the game as much as possible, and to do that you need capital. So point number 3 is that if the trade goes in your favor, only get out if the trade turns around and hits your stop loss. Don't take profit, because that could potentially limit your theoretical unbounded gains, because markets can just keep trending. Point number 4 is this is a strategy that makes absolutely no predictions about the duration of the trend or what's causing the trend. We just have to pick up on the trend. It's like catching a wave. All that you know is that if it starts to go in your favor, the aim is to ride it as long as possible until, the market turns around and it hits that predefined stop. Principle number 5 is that you can profit from rising or falling markets. It doesn't matter, because you can go long or short, so the only aim is to get the trend in the right direction. That makes it quite an attractive strategy, because you could theoretically make money in bear markets. So if you're trend following the US stock market, for example, you would have made a lot of money in 2008, 2020, given what happened in the markets. Element number 6 is that it only depends on price data, so we don't care about fundamentals here. As John Maynard Keynes said, markets can stay irrational far longer than you can stay solvent. So the point of this strategy is just to ride the trend. Don't worry too much about the underlying drivers, because you've got your stop loss, you know you can get out at a certain point. Principle number 7 is that you should focus on long-term trades, so have a relatively wide stop. The stop should really depend on how much you're willing to lose, and then also the volatility of the market. And you should be looking to ride the longer term trends rather than getting chopped up in the short term noise, because in the short term, there's just a lot more price variation and noise. So you should, trend following typically happens over multiple months. And if you look at a graph of the S&P 500, you can see that trends typically last for months and months at a time. Point number 8 is that markets might not be trending at any one point of time, and you just have to stay patient. And that might mean that you get chopped up, as I mentioned earlier. So you keep getting stopped out of your trades, but don't worry, because the ones that you catch, i.e. the waves that you catch, or the trends that you catch, will be the ones that more than pay for those losses from the stop losses. Point number 9 is that as a trader, you probably don't want to be losing money, but this is inevitable. So you have a lot to lose, as Mark Spitznagel's mentor said. Mark Spitznagel is obviously a famous hedge fund manager. He's written several books, Tao of Capital and Safe Haven. Obviously, humans don't like to lose money. We suffer from loss aversion, so that's something you have to overcome if you want to be a trend following investor. And point number 10 is that you can have a very low hit rate, because your winners more than make up for your losses if you manage to stick to your trading strategy. So the point there is that if you have quite tight stop losses, your losses per trade are going to be quite small, but your potential gains are theoretically unbounded. So it's important to stick to your strategy, make sure those losses are contained, and then when you eventually catch that trend and ride it all the way, you'll more than make up for those losses. So there we have it. That was a video on trend following. You can do this qualitatively or quantitatively, and there are some key principles to get you going. So I hope you enjoyed this video. If you want to hear more from me, don't forget to check out this one here. Thanks.